On behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I'm joined by my friend and co-host, Tobin Smith, out in sunny and scorching hot Scottsdale, Arizona.
72 degrees. Okay, let it go, Buffalo boy.
That does sound great. Sounds very refreshing. Well, I got to say, the markets have been doing great, Toby, and they've been wonderful, especially off of the news that we got from Sunday. But our featured guest is saying not so fast. Pump the brakes, because he's actually giving out a few warning signs. Dean Smith is joining the show today. Dean is the portfolio manager and chief strategist at FolioBeyond, and he's joining us from Spain today. Dean, welcome to Buy, Hold, Sell.
Thank you. Nice to be here.
Hola, ¿qué tal? ¿Cómo está?
Muy bien, gracias. ¿Y tú?
Muy bien. And when did you give up coaching college basketball? I can't remember.
Yeah, you know, it's funny. Back in the day, I had an office at DLJ, and they put a sign up in front of the office. They called it the Dean Dome. My office was called the Dean Dome.
That sounds great. Well, Dean, I got to say, I mean, one thing we could talk about basketball all day long, and especially you residing sometimes in the South there, and it's a little south of ACC country, but I got to say, with everything that's going on in the markets and all of the good news that's happening, why are you being bearish these days?
Well, I don't know if I'm a bear or if I'm just realistic. I think that
that means he's right, Todd. He's just trying to couch it in different
terms.
I'm
trying to ease in there. Yeah. Listen, the market has for some time now been swinging like a pendulum between euphoria and despair. Okay, so we were in despair not that long ago, a few days ago, and now we're in euphoria because the Chinese have agreed to someday agree that maybe we'll do something about this trade imbalance, and that is being hailed as some massive strategic win for the United States. I don't really see it that way. I think that the trade and tariff war that has been started with this administration is not over. It's barely just begun. And every time another little pause comes up for 90 days or whatever it might be, all that does is increase the amount of uncertainty that investors have to deal with.
Well, okay. I would counter this way. So we've been talking about Scott Bessent, my now Lord and Savior, who, according to my 32 years in D.C., some of my insiders in the GOP have said that they had a come to Jesus with Trump based around the concept that with a disapproval rate of like 78%, if we come into the next year midterms, that they're going to lose the House, they have a chance of losing the Senate, but more importantly, whatever stuff that they have not gotten done yet, they're not going to get done. And then why did we go through all this, ginormous pain? So the take I'm having is that they put a leash on him. He can babble on all day about, making up things all day long. But the idea that would somehow then re-escalate, I'm hearing from a lot of people there, it's just not possible because that would then screw them in an election. Now, what does that have to do with economics? Well, it has a lot. And the other thing is that they want the tax bill's now the focus, and that the tax bill would also be, I was going to say a good part of liquidity to get into the market as well. And that those two things are going to happen. So, all right, we'll have a bet, and our bet will be for some really good Spanish wine.
Okay.
Dean, do you see that though? Do you see this thing coming to a conclusion in the 90-day window, or what's your expectation?
Short answer, no. Listen. When Bessent went to Geneva, as he was boarding the plane, the president tweeted out or truthed out, whatever you want to call it, 80% feels right. Get it done, Scott. That's the marching orders that he gave. Now, where 80% came from, no one really knows. He didn't get that. He came back with basically nothing, 39%, but even that has been not gonna really be where we end up.
Sure.
The other thing that Scott Bessent was tasked to do, not this weekend, but previously, was get long-term interest rates down. Okay, I've got my Bloomberg screen right in front of me. The 10-year is now at 452. Okay, which is considerably higher than it was when he said that his goal was to get interest rates down. So nothing that they have said are their stated goals have actually come to pass. The other elephant in the room, and I think I'm using this correctly, that's the big thing that no one's talking about, everyone's choosing to ignore, is the EU. Okay. We reached a so-called deal. It's not really a deal. It's a framework for maybe coming to a deal with the UK. Trade between the UK and the US is about 1/10 of the amount of aggregate trade between the US and the EU. And the EU has Brussels. And Brussels has some very strong preferences about the way they like to have things run. Trade between the US and the EU, in fact, is pushing 2 times the amount of trade between the US and China. Okay, so there is a lot of wood to chop here. Nothing has been actually agreed to or accomplished. Everything the can has been kicked down the road. And in the meantime, we're dealing with tariffs that are 2 to 3 times higher than they were just sort of globally when this administration took office. So the cheers going up this weekend because we didn't have a full-blown tariff and trade war with China erupt over the weekend. We think those are misplaced, and I think the Treasury market is telling you that this is not going well. The other thing that we have to contend with, and I think this is really important, is the Fed. Okay, all of a sudden, the Fed has fallen off the table in terms of the main point of conversation. At the press conference after the last FOMC meeting, and a couple of weeks prior to that, at his speech in Chicago, Jay Powell said, "We're not doing anything. Okay, we are going to wait and see. We are equally concerned about economic growth and the labor market. Right now, it's at 4.2% on unemployment. That's pretty much full employment. But we don't know what's going to happen with these tariffs." He also said we're still concerned about inflation. Okay, we got a soft print on CPI the other day, but the effects of the tariffs are not in that number. Okay, those are numbers from April and before. So if Jay Powell's worried about slowing economic growth and inflation, then I'm worried about slowing economic growth and inflation. So the cheering about these non-trade deals is misplaced and way premature to anything that's actually occurred.
First off, Bruce, it is a pleasure to have you on this show. For my crying out loud, you've hit 3 points that I've been trying to hit for a long while, but you did a heck of a lot better than I did. I always go, however, back to the composition of the United States economy: 80% services, 20% goods and services. The fact that the top 10% or top 20% of households are literally 95% of discretionary spending. If you take those two numbers or those two facts, then that's where I don't get towards the recession deal. Also, I'll add another Besant thing. It wasn't Besant, it was another insider told me that basically said, "Hey, Trump, do you understand that if people go to Walmart and they're going, to buy summer clothes or so on and so forth, and that stuff is twice, 2x what they're normally paid for it, the yell, the scream and hue from the proletariat in the United States is going to be deafening, and we again can't afford to piss off the people who voted for us by making their Walmart bill twice as large, so that we're behind you, but there ain't no 40% going to be from China goods, since Walmart, Costco, everybody else is, essentially all their stuff comes from China or Bangladesh or Taiwan."
Here's a thing that we should have learned during COVID, and we've apparently already forgotten. Supply chains, global supply chains, are incredibly complicated and interwoven. Okay,
no question.
There is, I read the number somewhere, and I'm not an industrial expert by any means, but I read the number that before a car is delivered to a dealer lot, okay, some parts of it cross the US border from Mexico or on a container ship or wherever else, like 12 or 14 times.
14 times.
Okay. Yeah. Is that what it is? Okay.
Yeah,
good.
14.
I got the number right.
Yeah.
These supply chains are incredibly complex. There was a story, I think it was in the Journal yesterday, about some manufacturer who had some key components sitting in a warehouse or in containers in China, just not knowing what to do. They're going to be hit with 145% tariffs. The announcement came over the weekend that we're going to be a 90-day pause. They quick scrambled and got those containers sent over as quickly as they possibly could so that they could, get them in before the 90-day went. This is no way to run an economy. These supply chains are so interwoven and so complex, and they involve, it's not finished products, it's intermediate products, it's machine tools, it's components, it's rare earths, all of these things. And this tariff uncertainty is really messing with that. It's messing with it at a level that has not shown up in the statistics yet.
Yeah, it's going to. The certainty of uncertainty. The one I was really focused on recently was small business. And again, I was using the example of I go down to my bike store because I want to get some additional stuff because when you live in Scottsdale, you road cycle. Okay, that's I'm half the population. And Tommy was saying that I can't get any effing bikes, and I don't know how to price them. So how do I get inventory and price it so I make a profit and don't go out of business? And now he's basically shut down, and all he's doing is servicing.
Right.
Now multiply that by 7.5 million small businesses. I'm just talking retail. So I'm with you there. I mean, there's going to be pain. Again, I'm just in the camp that Trump blinked. He blinked for a very specific reason, and that he now it's retreat with honor. A, and then B, you're smart enough to know, like anybody else, that you don't take anything out of Donald Trump's mouth literally, because there's no truth in any of the things he ever says. But you look at the behavior, not the words. And the behavior to me has been that the crew surrounded him. Said you're going to lose this for us, and then we're benign, and they're going to take all the stuff away that you wanted to do. And oh, by the way, we haven't even figured out whether any of these presidential edicts are actually legal or constitutional. And yeah, by the way, that $400 million plane, that's going the fuck back to UAE after it's done.
Well, okay,
what's wrong with
I
the
agree
plane?
with you there, but it doesn't have enough gold apparently on the interior. Right, exactly. There's not enough. Well, listen. Here's what you're saying is I largely agree with, but if you are in the business of making capital allocation decisions,
no question.
Are you going to build this plant? Are you going to increase this inventory? Are you going to launch another product line? And you have all of this uncertainty. Okay, so fine, you can't take literally anything Trump says, but you can't say, oh, he doesn't mean any of it either. Okay, right. So there's the indecision and the volatility that arises from this sort of chaotic, let's call it policymaking to be generous, but this sort of chaotic announcement and pullback and delays and 90 days and didn't really mean it. That is going to reduce investment. It's going to reduce investment in plant and equipment. It's going to reduce investment by all sorts of businesses, large, medium, and small. It's going to cause individual investors to want to take less risk. So all of these things are adding to volatility. And that's what we think, whether we actually get outright stagflation, GDP declines. We did have one small decline. It was maybe a statistical fluke. But if we actually get GDP to decline, or if we just get a slowdown, whether we actually get increasing inflation, or if we just keep above the Fed's target so that they have to maintain interest rates at what is some people consider an elevated level. Right now, I don't consider them elevated. Historically, we can talk about that.
Yeah.
We are in for a period of continued volatility. And What that means investors need to do is take steps to preserve capital. Okay. So preservation of capital and generation of current income, those are the two goals. Not buying the dips, not timing the market. Those are the things that people should be focused on.
Okay.
Wow.
Okay.
Well,
That's deep. I got to say, I love it. Toby, let's leave it there, though. I want to hold that thought, your thought for the next block, because coming up next, we have more of Dean Smith, and we're going to ask him, we're going to put him on the hot seat, because we want to know, with all the growth that's taken place and all the money and the investment and everything else that we're hearing about in Saudi Arabia coming into the United States, will we actually hit a recession? And if tax cuts are even needed. But with us today is Dean Smith. He is the Chief Strategist and Portfolio Manager at FolioBeyond, and we'll be right back after the break. Please stay with us.
Buy, hold, sell, brought to you by Crosscheck Management.
Welcome back to Buy, Hold, Sell. Well, with us today is Dean Smith. He is the Chief Strategist and Portfolio Manager at FolioBeyond. And Dean, we were talking about all kinds of issues, particularly when it comes to the economy and with tariffs. But I want to talk to you about one of your ETFs that you have there. This Riser, RISR is the symbol. And it's unique because what I thought was it seemed interesting because you're trying to reduce volatility from the interest rate perspective. Can you tell the audience a little bit more about it?
Sure. This is a fund that we launched about 3.5 years ago. It has produced, since inception, about an 18% annualized return. So we're pretty happy with that. It's got a 5-star Morningstar rating, and it invests. It's very unique, as you say. It invests in a special type of mortgage-backed security. Now, these are all Fannie Mae, Freddie Mac, Ginnie Mae securities. There's none of that.
They're all guaranteed. It's all guaranteed.
They're all guaranteed. They're all AAA equivalent credit. And so these are MBS, mortgage-backed security, IO, interest only. So as interest rates go up, prepayment rates on mortgages slow down. The value of these interest-only securities goes up because you receive the interest for longer. This is a very well-known, very liquid, deep market that is really only accessible to institutional investors. And so we've taken what is really a hedge fund institutional style strategy and made it available to retail investors through this ETF. It has about an 18% dividend, which works out to be just shy of 6%. It has almost no correlation to the stock market. It has negative correlation to the bond market. There's really nothing else out there quite like this strategy. So including this in either a fixed income portfolio or a blended equity fixed income portfolio can really reduce the total risk in your portfolio while generating pretty attractive current cash income.
And the dividend is quarterly, or is it monthly?
That's monthly at 18 cents a month, stabilized dividend. Now, obviously, nothing is guaranteed, all that, but yeah.
I love that. So when we build a portfolio like we're doing right now for a family office, right? I start with the 6%, 7%, zero volatility as the base. So we use some ETFs that have zero volatility and pay 6 to 7%. But when you're talking about millions of dollars, and then we reinvest that because it again sort of if the market is shooting higher, then those assets are going to go up faster. Vice versa, because we're reinvesting, we're building the yield, and it's a hedge against some of the equity part of it, and particularly if it's a non-taxable type of account. But I love the idea that it's monthly. What's your call on interest rates then, big boy? Where are we going?
Yeah. People have been predicting interest rates are going to go down for a long time now. People who maybe have been around not quite so long as the three of us can only remember the last 5, 7, 10 years, and
interest rates are zero.
Interest rates are zero. They're supposed to be zero. They're supposed to be 2%. Well, they're not actually. The average interest rate on the 10-year, if you go back to the 1970s, 1960s, you look at the historical record, we're about there. Okay, it's between 4.5% and 5% is about where the 10-year typically lives over the long haul. We're at 4.5%. Think of it a different way. If the Federal Reserve's target for inflation is 2%, as they say it is, the average spread of the 10-year to inflation is about 2.5%.
Yeah.
Okay, that gets you to a 4.5% 10-year. That's where we are right now. Okay, that's a normalized standard sort of benchmark for the 10-year.
Mm-hmm.
We're not in normal standard times right now. So we think that interest rates are more likely to go up, at least on the long end. You know, the yield curve has continued. It's flattened a little bit in the last little stretch of time, but it is a lot steeper now than it was a year ago. That is also very common when you come out of a period when the Federal Reserve has been hiking interest rates, starts to lower interest rates, the yield curve tends to steepen. This is a very common historic pattern. People don't study history enough. Okay, they remember the last cycle, the last time that they saw what was going on. And if you look at the longer term history of interest rates and business cycles, this is not, it shouldn't be surprising to see that interest rates are where they are right now, and we think poised to go higher before they go lower.
Well, then you've got to have some feeling about, well, what if China just decides to unload 500 or 800 billion dollars of longer term bonds, and what if EU is part of their negotiation? Is that, we're sitting on us, Japan, China, us. We're sitting on 42. But forget about Norway. They're too rich anyway. But we're make a deal, or we're going to start selling bonds, and your 4.5% was going to be 5.5%.
Yeah. Well, if we really want to get into the macro weeds here on this thing, part of what has happened through all of this tariff and this decoupling, sometimes is the expression that you hear, is that people have started to question the strength and security of the U.S. dollar and U.S. sovereign debt. Okay,
10% down. 10% down to the EU.
Yeah, if you look at the credit default swaps on U.S. Treasuries, okay,
explain what those are.
The level, twice the price of.
Dean, explain what a credit default swap is.
Yeah, a credit default swap is essentially an insurance policy against default of a bond. Okay.
Yeah.
So if you are concerned about a bond defaulting, you can buy a credit default swap, and it will pay you if that bond defaults. Okay.
Right.
So if you could think about it as the price of default risk for a particular security. Right now, default risk on U.S. Treasury securities is just a little bit shy of the price of default risk on Chinese sovereign debt securities, and about 2 times the price of default risk on Euro sovereign securities. Okay, this is not good. So what is a possibility through all of this chaos, the term you did, is that the world begins to diversify and seeks to look for alternatives to the U.S. dollar.
And why wouldn't they? Why wouldn't
they? And this gets back to something we talked about before. The elephant in the room nobody's talking about is the European Union. This is a huge market with a very liquid currency. The euro is very liquid. Interest rates there are lower than they are on the U.S. dollar. If you are thinking in terms of global macro trends, I have to think that you need to be concerned about the U.S. dollar. And that is also not good for interest rates or the U.S. economy.
Yeah, it's strange, however, is good if I'm an American company and I'm selling into other countries.
Yeah.
So That's
But
one
if
reason why
you're a U.S. consumer, or if you're a U.S. company that needs to buy things overseas, guess what? They just got a whole lot more expensive.
no question about it. And shockingly, those prices will be added to the end result, because tariffs aren't taxes, Dean. I don't know if you go back. Tariff are not taxes. It's simply a way to stick it to the man who's taking advantage of us. So there you go.
Yeah, that's he's been beating that drum for a very long time.
Yeah. Oh God.
Go ahead.
Hey, Dean, you've touched on a few monetary policy issues. So what are your thoughts about Jerome Powell? His term expires next year, and do you think he should leave sooner than later?
Well, no is the answer. He's not going to. He said he's not going to.
But what do you think, though?
I think he stays. I think he stays until the end of his term.
And
what
is
happens
that good?
after that? Yes. I think that the last thing we need right now is turnover and uncertainty at the Federal Reserve, at the top of the Federal Reserve. I don't think, again, I'm not a constitutional scholar by any means. I did not go to law school. But from what I've been informed, the U.S. president does not have the authority to remove the head of the Federal Reserve.
Correct.
Jay Powell doesn't think that he has the authority. Jay Powell stated categorically he doesn't have that authority. I'm not going anywhere. I don't have anything more to say about it. And he keeps getting asked the question, and he says, asked and answered. Yeah. And so I think that we can be pretty confident that Powell stays in place at least through the end of his term. The other thing that I think is useful and important to keep in mind is that the remaining members of the Federal Reserve Board and the Open Market Committee have kind of got in line behind Jay Powell much more than they were maybe a year ago. You had some discordant voices and people talking about, well, maybe we should cut it, and that's gone. The Federal Reserve now speaks with one voice. It's Jay Powell's voice, and he has said, we're not cutting interest rates preemptively. We're not raising interest rates preemptively. We are going to wait and see what happens. Okay, so that takes the people who were saying, oh, we're going to have 4 rate cuts in 2025. Well, we're halfway through. We've had, haven't had that. We're going to have 3. We think the highest probability is 1 or maybe even none.
Yeah.
Okay. So the Federal Reserve is not going to come to the rescue here. There is no Fed put. And I think that is pretty much out of the decision making for investors. Don't be thinking the Fed's going to rescue you.
There's no question. I mean, that was interesting about creating your investment playbook day by day. Every one of the other crises we've had, we had the Fed cutting rates, we had injections of huge trillions of dollars, et cetera. So there was a Fed put, there was a U.S. government put, and there was a bank put in 2007, 2008, right? But when the government, when the government creates the chaos, you can't look to the government, number one. And then number two, the only terra firma we have really is the Fed. And the Fed is, if he was to be fired, you think that 2,000 point down day was something?
Yeah. I was having a conversation with someone the other day when I made the same statement. There is no Fed put. He says, well, yeah, but when Silicon Valley Bank failed, they came in and they intervened and they did what they needed to do. And I said, you're confusing monetary policy with lender of last resort.
Yes.
Okay. They will always be there as a lender of last resort. They are going to continue to provide liquidity where liquidity is needed. That is different from a change in monetary policy.
No question. Okay? No question.
And so
again, I think we have the Besant put. I think that's one of those things that Besant, got in his grill and said, you can say this shit, because you just make it up. But this one counts. You can't say this in the context of where we are right now, unless you want to be the president who tanked the market, down 40%.
That's what happened at Liberation. Remember Liberation Day? It seems like an awful long time ago. It was 6 weeks ago?
Yeah.
When they came out with this crazy formula that was multiplied by 4, divided by 4, and
Yeah.
it was completely unrelated to anything that made economic sense. The market, frankly, went to hell.
Yes.
And 7 days later, they said, "Never mind."
Never mind.
Just kidding.
Yeah. The Yiddish name.
So,
the Yiddish name is fakakta.
Fakakta. Yeah, I was gonna use that, but then I decided let's go for a broader audience.
Absolutely. Dean, final question here. So with all of the money that we're hearing about, trillions of dollars in investments coming into the United States, you have the deficit that is shrinking right now due to the revenue from the tariffs. And you have people that are working. You're hearing corporations talking about job hiring over the next 3-6 month period. With all of that said, you still have the Republicans out there today talking about tax cuts. In your opinion, do you think the U.S. economy really needs these tax cuts?
I think the budget plan that has been announced is almost as crazy as the tariff policy.
Yes.
And if that plan gets enacted, now obviously, no plan survives contact with the Senate. But if anything like that plan actually comes to pass in terms of the spending priorities, which are eye-watering in terms of the spending and the tax cuts, we'll be back here having a even more serious conversation, in my opinion.
Yeah. I sort of call it the emperor has no clothes budget. The people are afraid, obviously, because again, the midterms, they have to get a Trump endorsement, to win many of these tight races. It's like the first time that we've ever had, an all-powerful leader who now we have to supplicate to if I'm going to stay in the Congress or the Senate. And I'm not going to stand up other than a few people. And most of the people who stood up have left the Senate or left Congress. And so that's to me the most worrisome part. I'm going with Lord Bessent. It seems like he's the only one who stands up to the guy. And because he, A, is a self-made billionaire, and B, didn't get, $255 million from daddy in 1976, that he's the real deal. And I think Trump, back in whatever part of his dinosaur brain, understands this, that if Bessent quits, there's another 2,000 points.
Right.
Yeah.
And I think Bessent has leverage over him because of that.
Yeah, let's hope that doesn't happen. I think that he is, it seems like maybe the only adult in the room when it comes to some of these conversations. And, I just want to emphasize here too, that when I'm managing my investors' money, and I assume you gentlemen do the same thing, I don't manage it to what I would like to see happen. Yes. My personal political preference plays no role in this.
Same here.
I manage investor money to what I think could possibly happen. I look at different scenarios, I probability weight those, and I think about what's the best way to preserve my investors' capital, generate income, and produce a good return for them without taking too much risk. And that, unfortunately, or fortunately, however you care to look at it, right now requires real caution and
fortitude.
Fortitude.
You got it.
There you go. I love it. I love it. Well, guys, we're going to leave it there because I know the audience, they got a lot out of this conversation. That's for sure. Dean, thank you so much for joining us today on Buy, Hold, Sell. We definitely can't wait to have you back on.
Dean, let me just tell you this. Todd always tells everybody we can't wait to have them back on. In this case, it's actually true. We can't wait to have you back on.
I enjoyed it very much, guys. Thank you.
I will put some client money in your riser because that's a perfect part of our safety blanket part. So.
Yeah,
super.
Absolutely.
Happy to have you on board.
And that simple is RISR. We will have more information in the description of the show as well, and we invite everyone to go and take a look at it for yourselves. So on behalf of Dean Smith and Tobin Smith, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care.
Buy, hold, sell, brought to you by Crosscheck Management.